In David Zervos, he's the chief market strategist at Jefferies. Welcome.
Good to be here, Kelly.
This is fun.
Welcome
it's fun to have everybody here. Thank you. So, but do you take my point, Dave, that Steve is getting these readings which are horrendous at a time when we've actually seen the economy improve over the past couple months, at least in terms of price pressures?
I mean, there's been a theme throughout all of this that the consumer confidence surveys, University of Michigan and the Conference Board have all been really bad. I mean, they have not. Consumers have been unhappy for a while. So I don't think it's as surprising to me that Steve gets that data. There's a lot of frustration out there. COVID brought a lot of angst, the reopening difficulties and logistics. I thought the job stuff was kind of interesting, though, that people really don't see the risk of losing their jobs at all, which that was your silver lining.
I've been surprised as we've been doing all of this stuff that the low unemployment rate and the good job market has not played a bigger role in people's attitudes towards the economy.
Right.
It's inflation trumps everything.
Yes.
And I guess if you make a misery index, it doesn't matter how you get to double digits. Yeah. You can get there with the inflation numbers and the unemployment rate, or just the unemployment rate back in the 80s.
So why is it, Dave, are we correctly characterizing your views that you actually think things might be better next year than most Americans and most people in the markets right now think?
Well, I mean, better is, relative. Let's talk about better markets. Are we going to have better markets? I think, this year was a pretty tumultuous period for a lot of people in markets, especially in certain sectors, tech, obviously. But we've got 450 basis points as of next week of tightening in the Fed funds rate. We're going to have, I think, 400 billion of QT now and 500 billion by the end of the year. There's a significant amount of tightening that's been put into this marketplace, and I think the market keyed off of Jay's last speech at Brookings and realizes this is going to slow down, and they're going to not necessarily pause, but really slow it into Q1, and eventually we're going to just take a break from this breakneck pace of tightening, and I think that's a relief for markets. Will the economy, follow suit? It's more difficult to tell, but the inflation data do look like they're coming back down a little bit, and there were some good numbers today, right?
I don't think people are talking enough about it, and I know Kelly will, because she's one of the few people around here who's really focused on it. This unit labor cost number, and I emphasize it not only because it's an important number, but Powell has made it to an important number. It was the spike in unit labor costs that he made a big point of saying had kind of freaked him out a little bit. There's labor productivity. I'll come back to that in a second, guys. I don't know if you have that second chart. I didn't ask for it.
And let's remind people, unit labor cost is wages and benefits,
wages
right?
and benefits together relative to your output, right? Yeah. So that's a key thing. When that thing was up near 8.5%, it was a real reason to freak, so to speak. Now that it's down to 2.4% lower than expectations, look, if you could bring the labor productivity chart up again, I think we made a mistake, which is, there's the unit labor cost one. You can see that's well down. We had this surge in productivity that resulted from the fact that we had let go, all these people had left their jobs. We kept output up pretty high where it was. People came back to work and it fell. And people want to make these grand pronouncements or conclusions about the economy from the cyclical nature of a COVID-driven productivity change. And I'm not ready to do that. Like I said, I'm in the not sure camp because I want to know what the real productivity trend is. And we want to be very careful to kind of separate this up and down business in the economy.
Let's bring it back to what Dom was talking about, though, Dave. The yield curve inversion, one of the worst it's ever been. Look at 10s, 1s. 11 previous times it's inverted. 10 of them have been recession. The 11th, the Fed still had to cut. I mean, why shouldn't we take it as baked in at this point that we're going to be in a recession sometime next year?
Well, remember, we started this year with 2 consecutive quarters of negative real growth as parts of the curve were looking like they were going to invert. We may very well get a couple more quarters of negative real growth. I think that's certainly plausible. The interesting bit is we have very high nominal growth, so it's not a typical recession where we have deflation risks. We have inflation risks. That's very different for markets, something we've been writing a lot about over the course of this year.
And that can prop up earnings, maybe?
And that props up earnings, that props up valuations. The Buffett statistic, which is total market cap divided by nominal GDP, looks better when high nominal GDP is there. But I don't think we should get caught up in the recession really brings about some sort of major catastrophe for markets. The Fed probably needed to engineer a lot of this aggregate demand slowdown to anchor inflation expectations. They've done it. Everything suggests to me their credibility is actually near an all-time high, not low like many of the guests that come on here suggest. I think the curve in particular is very suggestive that the Fed has this under control.